Hey, everybody, welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we've got Matt Andersen on the podcast. He is the president and CEO of Westlake Securities, which is an investment bank based in Austin, Texas. Really cool episode because we dig into Matt's early career, talking about advising hundreds of companies through transactions, both on the buy and the sell side. He's also written two books that we dig into. One is Completing the Deal, which is out now, and then his other book called Intentional Growth, which comes out later this year in September, October timeframe. So we dig into kind of what the difference is between kind of Westlake Securities and a traditional investment bank, the types of businesses that they like to work with. And also we dig deep into intentional growth, what the book is, what it means to be supporting companies that are interested in intentional growth versus just exiting. So I think if you're a founder, you're trying to buy or sell a business, I think you'll get a lot out of this episode. So let's get Matt on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. All right, Matt, welcome to the podcast. Thank you for being a guest.
Well, thanks so much, Justin. Was excited to be here today with you.
Awesome. Well, let's jump right in. Maybe give a little bit of an overview of who you are, where you are, and what you're up to right now.
Yeah. So over the last 27 years, I have been in the finance industry. Over that time, I've been fortunate to have worked on and closed over $5.7 billion of debt securities M&A transactions, have been an advisor to hundreds of companies that were looking for strategic guidance, growth, M&A, liquidity, and then a best-selling author of two books, Completing the Deal and Intentional Growth, and speak internationally on the topics of growth, capital raising, mergers, and acquisitions. So that's kind of my day job. Also kind of fortunate to have a wife and two kiddos that are now probably young adults, I would call them, and have some extracurriculars outside of life and finance. But I'm in Austin, Texas, and have been here since about 2007. So it's kind of like an early settler, so to speak, and originally from just outside Chicago.
Got it. Fair enough. Well, there's a lot to unpack there. We'll talk about the book in a bit, but let's talk about Westlake. I guess, how did you get into kind of starting Westlake? How did the whole process work? Like, I'm always curious about people's origin stories and how they start businesses. And then I'd love to understand your kind of take on the markets right now, as it looks like kind of investing and selling businesses.
So my origination with Westlake came about in a little bit of a different way. So I was working for a large publicly traded company, and I ran a P&L, separate kind of P&L control over that a division of that company for about 7 years, and grew that division from about 3 million to 15 million of EBITDA. After the public company sold and was taken private, wanted to actually do something a little different with my career. I'd spent kind of the first 15 years of my career helping big companies get bigger through acquisitions and growth strategies. And so when the last company sold, I joined Westlake originally as a managing director. So Westlake was actually founded in 2003. It's one of the longest running investment banks. It's headquartered in Texas. And so I joined in 2014, and then over time became CEO, and then essentially kind of acquired the business in 2019. So kind of had a little bit of a different journey, but I will say, over that time period, really kind of rebirthed the business. The business was originally a business that did trading, research, capital raising, and M&A for companies of all different sizes. And today we're largely what's called a lower middle market investment bank that really does two things. We help companies grow, and we help companies organize their liquidity strategy and execute them. So, but it's been a fun journey. I would say, that time period, really the industry shifted quite a bit. And so we were kind of able to reposition the company based off of a changing industry that was, not the most friendly to things like trading and research of publicly traded companies, and very friendly to rising kind of lower middle market activity in the M&A sector.
And I've talked to a number of people on the buy side and the sell side, and everybody has seemingly a different definition of lower middle market or middle market and all that fun stuff. How do you define it? And maybe what are some of the target industries that you and Westlake kind of go after?
So we really think of lower middle market as maybe 2 or 3 million of EBITDA on the low end, and maybe 30 million at the high end. That generally would be, probably a fairly classic definition of lower middle market. I think there's probably some people that would move those numbers around a little bit, but that's kind of how we view it today. It's kind of how a lot of the data and statistics are oriented for different subscription services that we subscribe to. That's kind of our view of it. As far as industry types, we are a what I would call a narrow generalist, which is a bit of an oxymoron. So we are a generalist, but we have kind of 4 categories that I would say excel in particular: manufacturing and industrial, business services, tech-enabled, and food and bev. Those are kind of our 4 core. We have done another number of kind of healthcare, medical device transactions over time. We've done some things in financial services over time, but I would say, every year we're going to have closed deal activity in those 4 categories I mentioned.
And, we're recording this in kind of late June 2026. There's a lot of things going on geopolitically, which we won't dive into on this podcast. But how have you seen kind of the market shift, over since you acquired the business in 2019? Obviously, we had COVID. We had a lot of things happen between then and now. We had the boom in 2021 where everybody could get funding and all of that. Being on the kind of sell side, from where you sit, how have you seen the market trends shift towards people are they still going after tech businesses, or do you see kind of your sectors that are more manufacturing, business services, tech-enabled things, are they starting to heat up even more so than they had been?
Yeah, it's a great question. And I would say right now we're calling for a little bit of like what we call the perfect storm. There just is so many, there's about 16,000 companies that are owned by private equity. A lot of those are getting long in the tooth. There's $1 trillion of dry powder. So dry powder is being defined as capital that's been committed to be deployed but hasn't yet been deployed. And so we think there's going to continue to be a lot of activity. I think if you look at the data, there are certain segments, and I would call them the businesses that do real things segment. So that may be, residential and commercial services, that may be manufacturing, industrial, et cetera. A lot of those sub-industries are actually seeing kind of 20-year all-time highs in terms of EBITDA multiples, which is really neat. And I think that's a combination of just the supply of capital and competition for those deals. And then we're seeing some industries that are a little bit of a question mark. I would definitely say, tech-enabled services, is still a little bit of a question mark. I think there's a big discussion around, how is AI going to ultimately impact those businesses? And I'll give you kind of a quick, for instance, I was visiting with a CEO who kind of built and sold 3 companies. He's on his 4th. And, basically we're talking over coffee, and he's like, I've gotten this 4th company to a point where I've spent kind of $2 million, and I forget how much time he put into it, but it wasn't much time, but about $2 million in an X amount of time, let's say. And he said, my other companies, it probably would have cost me, $10 to $15 million of spend to get to where I have this company at with 2. And so I think there's a little bit of a question mark in terms of, tech-enabled and what some of those companies are worth relative to AI. And so that's a segment that we're still excited about. We still plan every day, but we do have a little bit of a cautious eye towards it. And valuations come down too in tech for sure.
Yeah. And I know you're based in Austin, but are you primarily doing deals in Austin and Texas, or are you entertaining and working on deals all over the country or world?
Well, yeah, great question. We've got about 60% of our client base is going to be Texas-based. The other 40% is in a given year is going to be coast to coast. So, within the last 18 months, we've actually had transaction activity in Miami all the way to LA. We've got some things cooking in Europe right now. I'll actually be over in London. In July, we have some conversations going with companies that's in Canada. I'll be there in September. So really we'll look at things. We're not kind of geographically constrained. I mean, Texas is kind of a normal or go-to just because of our presence and also the size of the state. As a standalone, I think Texas is the 8th largest economy in the world. So, we're a short drive from a lot of businesses being based in Austin.
So I want to unpack a little bit around the manufacturing and business services. I think you coined it kind of the companies that do real things. I'm curious about how do you evaluate if a company is ready to work with you on the sell side? Is it just size? Is it operational efficiency? I've heard a lot of conferences, the key man risk is a very big thing in the lower middle market, because if it's Justin's plumbing services, if Justin leaves the business essentially goes away. So I guess, how do you evaluate whether a company is ready or kind of big enough or ready enough for you guys to kind of lean in and start the sell side process?
Yeah, great question again. And we actually have a liquidity assessment that we'll run through. But I would say if you were to unpack that a little bit, the first thing that we are looking for is size. So we are in a market of doing kind of institutional deals. So really kind of EBITDA starting at $1.5 million to $2.5 million, depending on the industry, is really where we need to start. So if something is below that, every once in a while we'll kind of engage in conversation, but predominantly we're looking for businesses that can be of scale to transact in a platform. And so a lot of times that's really going to kick us up into that $4 or $5 million EBITDA range. Anything south of that, we have to see the opportunity for it to either be a platform or an add-on. Okay. So that's going to be number one. Number two is we do want to go through the people process system assessment. We've got a trademark process that we go through called QVG, quality, value, growth. And what we do is we take a 360 analysis of a business and really kind of make sure that it's ready to transact. And then lastly is we have a lot of conversations around value expectations and market data. And we want to make sure that there's some alignment there in terms of view of value. As you can imagine, sometimes we'll get into a conversation and somebody will say, hey, I think my business is worth, X. And then we'll look at the data and it's here. And then we'll look at the business in particular and it's kind of in this range. And so we have to have that conversation around what are going to be expectations from a transaction perspective. But if the size is there, if the QVG metrics are there that we grade, and the expectations are going to be in some realistic view of market, then we get super excited about that. And we have a very high percentage chance of closing a transaction like that.
How do you have the conversation with a founder or owner of a business that has unrealistic value expectations? Is it really this is where I think we can transact, and if you don't like that number, kind of, we're not maybe the best bank for you? Or is there a way to kind of get them back to reality, if you will?
So there's kind of 3 types of response drivers to that. 2 of them we can deal with, the third one we can't. So number 1 is maybe just a lack of knowledge, right? So when you ask somebody, what do you think their business is worth? And they reply X and it's 50% over market. And you ask, hey, have you really ever dug into market comparables? No. Well, do you mind if we show you some? If they're open to that and they're willing to be educated, we've got a lot of data. We subscribe to over $100,000 a year we spend on data on private transactions. And so we will build a customized report for them that will actually look at different transactions that have occurred in their industry segment, typically based on NAICS code. So however they file their taxes, we can kind of narrow down or vector down into transactions that have occurred with a similar NAICS code. And so the first is just a lack of knowledge. And we can deal with that. Secondly is they're really after the number. And the number is the number that's going to take for them to step away from the business and have the sort of retirement that they want. And if there's too big of a gap there, a lot of times what we'll talk about is, okay, rather than transacting today, what if we were to take 3 years and to really grow the business into the value it is that you want? And that was actually kind of the genesis in part for my next book, Intentional Growth. So it's really kind of, can we step back and actually make the business worth what you need in order to kind of achieve the financial success that you're after? And that we can deal with. The third one is the difficult one, and that's what we call the seller who's looking for an alchemist. And an alchemist is, they're going to give me sand and water and ask me to make gold, and that's just pretty tough. I mean, Point us towards a gold mine and give us a pick and a shovel, and we'll dig away. But if you're going to give me water and sand to deal with and ask to be turned into gold, that's pretty tough. And so that sort of seller is the most difficult. But the first two, we can either educate or we can work with to grow their business into the value that they're after. But the third, who's after just unrealistic outcomes for where their business is at, that's generally speaking the toughest.
Well, it's a perfect segue into the book and into the intentional growth kind of mindset. So maybe give us a little bit of an overview of what intentional growth is as a book, but also as a philosophy, and how you help the entrepreneurs and the founders kind of go through that process, who maybe fit that second criteria where they have a number, but they have a little bit of runway where they're willing to kind of help work with somebody to grow their business to get maybe the ultimate valuation that they want. So let's kind of talk about the book and how that works.
Sure. So there was a lot of, I guess, mosaic pieces that came together as to, why I felt passionate about writing intentional growth. I would say, firstly, like our industry is a little skewed to no matter what your question is, the answer is to sell your business. And for a lot of people, that's really not the right answer. And so, for a lot of times somebody says, hey, I really want to grow my business. I want a 10X it. I want to go do some acquisitions. And so the answer is, well, first sell 80% of your equity and then go do what it is you want to do with your business. And so that was kind of number one. Number two was, over time, I've had a lot of experience as an operator, as an investor, as a board member, as an owner myself in terms of what it takes to 5 or 10X a business or even beyond that. And I'm happy to share a little bit of background as to kind of the first 15 years of my career and where a lot of those kind of early examples were. But I think, to me, it was kind of important to have a framework that people could more predictably grow their business based on, over a quarter of a century of experience. And then number three was we just had a lot of outpouring as to people who want to unlock growth, want to really kind of get to that next level, but weren't really sure how. And there's a lot of books out there that we'll talk to maybe, how Google did what it did or LinkedIn did what it did, but not really kind of geared towards kind of the lower middle market, or even the small publicly traded company about how they can predictably unlock that growth. And so those were kind of the three things that came together for the book. And when I did the book, I really wanted to create something that was a living, breathing book. And so at the end of each chapter, there's downloadable Excel sheets or forms or tools, and then there's interactive forms and tools that people can use to kind of bring some of the philosophy and strategy to life into tactics, like actual deliverables. And so the book is much more than just, it's a three-dimensional experience in the sense of, as you read, there's going to be downloadable, interactable tools that you can use to bring some of the ideas to life for your organization. And so that was kind of the genesis of it. And we use the same in working with our client companies that want to grow. We use this exact process. And so I wanted to share something that was very open and very transparent in terms of how somebody could more predictably create an outcome that matters for their company.
And so when you find the kind of level two or the second option kind of business owner who wants to sell their business, but maybe they don't fit the valuation that you need to kind of make it make sense to sell, but also maybe they've got some runway, how do you engage with them to go through this intentional growth process? Like, is it like, maybe walk us through for instance, that, if somebody's listening to this and they're maybe sitting there, I own this business, I'm at 2 million of EBITDA, and I've tried to grow, but maybe they just haven't had the right partners, the right process. Like, what does it look like if somebody's sitting there that's like, hey, I want to grow, I want a partner to help me do that. How does it work from your side?
Yeah, so a lot of times we start with reverse engineering. And so what we'll say is, Justin, you've got this business that's 2 million of EBITDA. Market says it's probably worth $10 million. You'd really like the business to be worth 25 million. Okay, I'm just as an example. And so in order to get to 25 million, we really need to get EBITDA, kind of closer to 4, maybe pressing 5 a little bit. And then you may say, okay, that sounds great. And then, we're talking and you say, well, I'd really like to get there in 3 years. And so great. We've now got a vector. We've got 3 years to get the business from 2 to 4.5 million. I'll split the difference on the EBITDA from 2 to 4.5 million. And what we'll do is kind of start backtracking the different levers that exist for a company based on that size or a particular industry that they can pull in order to actually achieve that result within that timeline. And we map all that out. And I think one of the arts in all of this is, making sure that when you look at those levers to pull, that they're appropriately placed over that 3-year timeline. One of the major mistakes that we've seen companies make over time is they have enough good ideas to kill a company, meaning they show up to their management team or their company after having attended a seminar and say, gang, we were going to crush all 8 of these objectives within 3 months. And inevitably, it leads to failure. Too much, initiative overload, it leads to failure. And then that's kind of where growth just kind of poo-poos and it slows down and it stops where it is. And so we tend to kind of, I would say, overestimate what we can do in 5 months and underestimate what we can do in 3 years. And so probably part of the art of this is once a team or an owner kind of understands what the levers are, it's really kind of layering in the execution of those layers, at appropriate times throughout that 3-year journey in this case. And then, also understanding sometimes the organization just doesn't have within itself what's necessary to go from 2 million to 4.5. It may mean making some big hires. It may mean making an acquisition. It may mean doing another greenfield. It may mean taking some sort of upfront financial risk in order to kind of hit those timelines. And so then we start to have some of those discussions as well. But it all starts with reverse engineering. What time and what financial results are we after within that time?
And then do you guys get engaged on kind of like a more traditional consulting retainer model where it's like, hey, we're going to bring in our experts and we're going to help you build this plan? Obviously, your ultimate goal is to sell the business at some point for the valuation maybe that the seller wants. But is that kind of how the model works for you? And then obviously you get the kicker at the end when you actually end up exiting.
Well, so every company in every instance is a little unique. So there are some where maybe that is the case, where the shorter the time frame is. Mostly what we're trying to do is to, if that is the goal, is to have growth and get to a liquidity point, great. And we have other companies that we advise from a growth perspective, for instance, that are really wanting to grow to make sure the enterprise value is interesting enough so that if the business is passed down to generation 2, and there's now instead of one Gen 1 owner, there's now 3 kids or 3 Gen 2 members that are in the ownership group. They really want to grow the business so that it's still meaningful to the 3 participants. So let's take your case study example, for instance. Let's say you're Gen 1, you've got this $2 million EBITDA business, it's worth, $10 million. And so for you, that's kind of interesting, right? But if you were wanting to pass that business on to 3 Gen 2 members, 10 million divided by 3 is a little bit less interesting, especially depending on where you live. I mean, it's hard to say that after, if you were to sell a business for $10 million and split it 3 ways after fees and taxes, et cetera. I mean, it's not a bad day. It's a good day, but it's not really generational wealth by a long stretch. And so if you were to go down this intentional growth path and build a business from being worth 10 million to 25 million, over 3 years, and then transition the business to 3 children, now that's, 25 divided by 3 starts to be a pretty interesting number. And so we have folks that's what their main goal and objective is as well, is really building a business that can support being transferred from one generation to the next.
Okay.
And we have a little bit of a different fee structure for that.
Yeah. And then do you bring in kind of partners, private equity groups, other kind of industry experts to help kind of advise in different areas of the business? Or do you have your own internal team that's kind of across all the gambit so that you can kind of be a one-stop shop?
So we tend to be a bit of a one-stop shop, although I will say we definitely have outsourced partners. So for instance, on our team, we have people that are experts in capital markets and M&A. We've got folks that are on the marketing side, finance, accounting side. So on the marketing side, for instance, they've worked with major brands like Ryobi, Gatorade, Hershey's. On the finance and accounting side, we've got people that actually used to do audits and quality of earnings and things of that nature that are working with our companies. And so they're there to really kind of play various kind of quarterback roles based on expertise. But we may, for instance, if we're going to run, specialty ad series, for instance, on the marketing side, we'll probably go find a firm that kind of does whatever that specialty is every day. Or if we are going to do a forensic accounting exercise for something, we'll probably go find a firm that will do that forensic accounting, general ledger entry or assessment. But our folks will largely serve as the quarterbacks for key strategy and tactical decisions.
Yeah. I know you're not kind of a pure kind of tech focused bank, but how has AI kind of played a role in making your lives easier as a firm to kind of, help speed up analyzing deals, analyzing markets, et cetera. But also has AI kind of added some complexity when you're trying to evaluate a company to understand, are they really using AI, or is it just a really nice wrapper around an LLM or something like that may be disrupted in a few years? So I'm curious kind of the both sides as an organization, how you're leveraging it, and then also how are you kind of mitigating it to make sure it's not a risk in a business that you're trying to sell?
Yeah, so from a use perspective, we're using AI across the board every day. So whether it's using AI maybe to do kind of research, so we've got skills inside of some of our AI platforms that we use that will help with research. We've got other AI tools from a finance and accounting perspective, materials generation, analytics on our own CRM, things of that nature. We've been very AI forward. In fact, if you were to go to our website, we've got lots of assessment opportunities, and the first draft, a lot of those assessments now are being done through and with the assistance of AI. There's still a very human element to a lot of them after we get the draft, and a lot of customization that goes in. But the first rounds of drafts are much more reliant on technology today than they were, even 6 months ago. And so we are, I would say, an AI forward company in the sense that we are using kind of AI from start to finish. I mean, from Copilot and looking through, email scans and calendar items, all the way through more sophisticated kind of tools and skills with Claude. So we're very AI forward, and it's hugely helpful. I think there's a lot of things that can be, very time consuming that are low value that AI can really be helpful with in today's environment. From an underwriting a company perspective, there's a couple things that we're looking for. So in a traditional business that may not be a tech-centric business, we are looking to see, are they adapting? Are they starting to use some of the basic functionalities all the way through? Are they thinking ahead for what's next? And so there's a lot of industries that are can greatly benefit, for instance, from capturing data and knowledge from maybe those are in the third and fourth quarter of their career in order to pass that down to and make learning tools for those that are in the first or second quarter of their career. So we look for things like that. In tech-oriented businesses, what we really want to understand is where the additional kind of connectivities are to the pure technology. And so I'll give you for instance, if a tech business has certain kind of data connectivities to the end user, as well as a maybe inputs or other kind of difficult to get connectivities that are data oriented or information oriented, and the technology is living in the middle. We feel really good about those sorts of organizations because I think there's a lot of value in the various kind of connectivities that need to exist versus maybe something that's a cloud-based software program that, it's kind of a one-dimensional in the sense that the user goes in and they get out of the software what they need, and the software is not dependent on other sort of data or information. I think that those kind of models could be a little bit more at risk in terms of competitors looking at what they're doing and being able to kind of replicate them, in a much less expensive way than maybe they could have even 2 years ago. And I'll use that example I shared earlier, the CEO kind of creating tech that normally would have cost him 10 to 15 million, he did for $2 million.
Yeah. I'm curious, kind of as we wind things down here, you mentioned that there's 16,000 companies owned by PE, many of which are probably should have been sold, or they hope they wish they could have sold them a few years ago. And there's a lot of dry powder. I think you said about 1 trillion in dry powder. I guess as we think about the next 6 months and maybe the next 12 months, where do you think, or what are your kind of crystal ball vision of the M&A market in lower middle market? Are we at this inflection point where it's just going to be the barn door is going to burst open and there's going to be a ton of M&A, or are we still in this kind of wait and see mode? Like, what's your thoughts?
Yeah, so we're generally giving people guidance that if you want to do something in the next 5 years, do it probably in the next 2 to 3 years. And you'd kind of say, well, why is that? So one of the things that we can tell from data is that, dry powder and supply of capital does a lot of things. It creates activity. It causes valuations to go up. And conversely, the lack of capital or lack of dry powder, you see the opposite, less transactions and lower values. And so those two things are kind of highly correlated together. And I will say kind of like, from what the data suggests, the back half of 24 was fairly light, in particular for our markets in terms of fundraising. 25 fairly light, first part of 26 fairly light. And so what we think is there was a lot of heavy fundraising from 21 to 23 in particular. Those funds still have a lot of dry powder, but they're starting to get into the end of their investment cycle. So most funds, when they raise capital, they have to invest their commitments within 4 to 5 years. And so those heavy fundraising periods, their timelines are starting to wear out. And then the last couple of years, the last 24 months, has been much lighter fundraising, in particular for lower middle market transactions. And so we're just kind of generally saying, like, look, we don't have a crystal ball. Data's not perfect. But if I were a betting person and wanting to do something in the next 5 years, I would say the next 2 to 3 is going to present the most dry powder, in particular for lower middle market transactions that we may see for some time period. And that could change very quickly. We could see the back half of 26, the data comes in and there was a ton of money raised and all's good. But for right now, based on what we know, looking out into the future, the next 2 to 3 years should be fairly robust and a good time to transact because that supply of capital is keeping activity high as well as supporting valuation.
And then your buyers of the companies that you're representing, are they typically private equity firms? Are they typically strategic buyers? Like, where are you typically transacting?
Yeah, all the above. So within the last kind of 3 years, we've transacted with, family offices of all different sizes. We've transacted with large publicly traded New York Stock Exchange listed companies as well as private equity funds. So when we run a process, we are typically looking across probably those 3 gamuts of potential buyers, so larger strategics, private equity, as well as family office. Those tend to be the main buckets we look at. We'll also, depending on the transaction type, look at, fundless sponsors or search funders, depending on the size and type of transaction. But those 3 are our core: strategics, private equity, family office.
Awesome. Matt, it's been a lot of fun chatting with you. I guess if people are listening to this and they want to learn about the book, first of all, when does the book drop? I think it's October sometime frame. When is it dropping?
Yeah, so first book was Completing the Deal. It was the number 1 Amazon bestseller. It's available today. Definitely would encourage folks that are transacted minded to consider that as a read. Intentional Growth is available for pre-sale, more growth focused. It will officially drop October 20th in terms of delivery dates. We're going to have some launch stuff going on with Austin Business Journal and a bunch of fun launch stuff kind of coming up. So stay tuned for that. But it is available for pre-order on Amazon today.
Awesome. And then I was looking at your social on LinkedIn, and you've got I guess an intensive summit for intentional growth-minded entrepreneurs or founders. Talk a little bit about that. I know you've got one coming up in July, but I think there's one coming up later this year also.
Yeah, exactly. So we've got one coming up July 23rd. It's going to be a 3-hour intentional growth intensive with myself and 2 of our teammates are going to be presenting. It's going to be a great time to really dig in on prepping for growth and learning a little bit more about some of the tools that are available through the book. We're going to do another one in September, and we're going to provide the dates and link information. But for your listeners, I'd love to give a 50% discount. So Normally, that session is $599, or let's call it 600. So we'd love to create like a 50% discount coupon for your listeners to attend our September session, which will be, really impactful. And I think for folks that are growth minded, it's going to be a fantastic investment of time.
Awesome. Yeah, well, I'm excited to put that stuff in the show notes and obviously promote both the book and the summits and the intensives as we get closer to those dates. So, Matt, it's been a lot of fun. I want to kind of round things out with a 3-pack of questions that I ask every guest. The first question, you may be already mentioned a book, but I guess the first question is, what's a book you found helpful or influential that you would recommend to the audience? And you can recommend your own if you'd like.
Well, having read Intentional Growth 3 times in the last month for edits, I would say that's the book that's most impacting me right now. But there's a number of great books out there. I always kind of go back to The Intelligent Investor. If people haven't read that, it is the first and foremost place to start. I think there's some great lessons in that book. It's been highly influential for me over time. But there's a whole host of books that I can share, and if you want, I'll give you my top 6 that you can post in the show notes from kind of key book takeaways. But that's definitely kind of a go-to. The other one that I would suggest real quick is Ogilvy on Advertising. It's a book that came out, decades ago, but I think it's just a great conceptual view of really kind of the core context of marketing and branding, which really isn't just about ads and fancy fonts and things of that nature, but it's really like, how do you make a market? How do you really grow revenue through the communication of message and research and data? And there's a lot in there about research and data that I find kind of interesting as well. But I'll get you my top 6 and you can post them in the show notes.
That'd be great. No, I'd love that. Awesome. Second question here. What is your favorite thing to do outside of the office?
So outside of the office, I am an outdoors person. Number 1 is going to be fly fishing. So okay. I'm an avid fly fisherman, whether it's, rivers, oceans, bodies of water of all sizes and types of fish of all kinds. But that's my number 1. And so I'm actually hopeful in a couple of weeks to be in the mountains, kind of doing a little bit of fly fishing, looking for some brown and rainbow trout.
Very cool. Very cool. Last question here, Matt. Favorite vacation spot?
Ooh, gosh, this is an easy one. It's going to be Italy. Okay. I'd say outside of the U.S., Italy is kind of the go-to. I'm a pretty frequent traveler there, and we'll be headed there in August for a couple of weeks. But that's one of my favorite spots. I've really enjoyed Europe as a whole, South America as a whole. But I think if I could only go to one country from now on, it probably would be Italy.
What region of Italy? Italy's a big country, so where specifically, or where areas you like?
Yeah, so I'll kind of draw 4 areas in particular. So the broader kind of Tuscany region with Florence as a home base, I think is a must. It's fantastic. There's so many day trips that you can do from Florence, and Florence in and of itself is a very unique city. There's just every corner there's something to go do. But again, there's so many day trips to Siena, Arezzo, the Leaning Tower, Pisa itself. I mean, there's just so many interesting things that you can do from Florence. The Venice is a day trip by train, so it's a great home base. Number 2 is going to be the Amalfi Coast. It's a pretty tough area to beat. In particular, if you're looking to actually truly relax, it can be a great area just to kind of unwind. Rome is fantastic. There's city blocks that you could almost dedicate a decade of your life just to kind of understanding what happened in that one block over the last 3,000 years. And then last but not least is in the north. The Como all the way through southern Switzerland is just fantastic. Lugano, Switzerland in particular, which is a very interesting area, even though it's in Switzerland. The official language is Italian, and the food and culture is Italian, but it's mixed in with Swiss culture. It's a truly unique area as well.
Very cool. We'll have to talk we'll have to trade stories about Tuscany a little later. So that definitely a high place that my wife and we went and definitely want to get back to very soon. So Very cool.
Well,
Matt, I appreciate.
We should do a travel podcast together. That sounds like a lot of fun as well.
I would be completely down for that. We can definitely talk about that as well. But this has been a lot of fun. If people want to learn about kind of intentional growth, about Westlake, like what's the best way to connect with you?
Yeah, number one, check out the website, westlakesecurities.com. Number two, find Westlake Securities or me, again, Matt Andersen, spelled S-E-N at the end, on LinkedIn. We're pretty active there. We post a lot of free information, a lot of great information, and you're going to be able to kind of keep up with what's going on with the book and the launch on either, again, Westlake's profile or my own on LinkedIn.
Awesome. Very cool. Matt, I really appreciate you being a guest, and thanks for being on.
Justin, thanks so much for the time. Really appreciate it. And best to you this summer. And until next we talk, let's grow.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.